morning. I'm Larry J. Ripka, CEO of the Valmark Financial Group. One can't watch the news, read a newspaper, or read any financial journal without a discussion of what's going on with U.S. equity markets. As I record this, the 1st of July, year-to-date equity markets are down anywhere from 15 to 20%, depending on the index that we're measuring. And in spite of this volatility in equity markets, surprisingly, U.S. life sales concerning variable universal life, which involves equities, are up 50% year to date. Our own sales through the end of June in variable life are also up significantly. I'd like to talk about why VUL makes sense for most consumers in spite of the volatile equity markets that we see. And this morning, I'd like to attempt to answer 3 questions. Well, let's turn to that first question. Why does it make sense to still buy a variable policy today for clients who are looking at permanent insurance? Well, it starts with the time horizon. Any client who's choosing to buy a cash value permanent product over term generally has a time horizon 20 years or more for it to make sense, especially when we look at term rates that can be guaranteed for 10, 15, 20, or even 30 years. If it's a temporary need, term insurance often is the best solution. But if we've got a permanent insurance need, then our choice basically comes down to 2 types of products. A general account product, where the insurance company buys the investments, mostly bonds and mortgages, and has a fixed rate that they credit to the policyholder, or a variable policy, where the consumer chooses how to invest his or her cash values. Now, with variable policies, the consumer can choose anything from a bond, mortgage, money market fund, all the way up to various equity choices. And as we think about this, it really is this equity or premium that equities have historically earned over bonds for longer periods of time that is the driving force behind variable life. You can see on this slide here, I have a range of returns from 1921 through 2021, essentially 100 years of various 30-year periods. And in all of those 30-year periods, equities have outperformed bonds. Now, in shorter periods of time, including one like we're seeing now, certainly bonds have outperformed equities in 2022. But if we define life insurance as making sense in these longer holding periods, it's easy to see why having that higher return will make a difference. Now, back when I was first getting started in the business and wrote one of my first published articles, A Case for Variable Life, this was one of the main things that I talked about, and I was invited to speak to various groups. And I wanted to make a point that if we were funding trusts with various choices of bonds versus equities, that the compound difference between those investments would make considerable dollars over time. So in an example, a hypothetical example, by the way, I said, let's assume that when I was born in 1961, that my grandfather created a trust and put $100,000 in that trust for me. And I also said, let's assume that I had a twin brother, which I don't, and he put $100,000 into that trust. With 2 separate trustees. The first trust invested completely in bonds and reinvested as those bonds turned over, sometimes at higher bond rates, right now at lower bond rates. The second trustee, looking at a long-term time horizon, said we're going to invest 50% in bonds and 50% in equities. We paid out the income or maybe my grandfather retained the income in both those trusts. And let's assume that neither me nor my twin brother knew about this trust until our grandfather's death. So I get a letter in the mail saying your grandfather set up a trust for you, and let's say my trustee invested 100% in bonds. So that 100,000 is still worth 100,000. We assume no defaults on any of those bonds. They all paid and are rolled over. And on the second trust, my twin brother gets the proceeds of what was invested in bonds and mortgages. I happen to pick up the phone and call my twin brother and say, "Did you hear the news? Grandpa left us both money in trust. I can't believe it." And my brother chimes in, says, "I had no idea that Grandpa had this much money. I got $4 million. Now, I'd have been pretty happy receiving the call that I got 100,000 I didn't expect, unless I compared it to the $4 million that would have resulted during the same period of time. Now, someone might say, well, the market's down now. That's true. So maybe my twin brother has $3.2 million instead of 100,000, but that doesn't make me any happier. What does this have to do with variable life and the current market volatility? It really goes to our second question of how much does variable life cost relative to other products? And it should be a simple question, but it's difficult to answer. It's kind of like saying, well, how much does a white car cost? And if I went into a Chevy dealership, probably the first thing, is it a new car or is it a used car? But if, assuming I'm just looking at new cars and I see three white cars on the showroom, I see a brand new C8 Corvette, I see a Suburban, and I see a Chevy Volt. Probably the Corvette's going to cost a little bit more than the Suburban, but I'm not going to make my purchase decision just on cost. I've got to say, well, what is this car supposed to do for me? And a good car salesman would say, what are you going to use this car for? So if my primary concern is getting from point A to point B for the least amount of gas costs, I'd probably buy the Volt. If I have a large family and I have to transport people and haul stuff, the Suburban's probably the best choice. And if I'm really interested in getting from point A to point B the quickest, or maybe with the most fun, I'd probably choose that C8 convertible, the Corvette. In the same way, as consumers look at various types of insurance, a good financial advisor should be asking additional questions, not just what's the premium. We started with how long do you need the coverage? But a second question is this cost guaranteed? A third question that probably should be asked today, are you concerned about inflation? Especially if we're talking about policies that might go for 30 or 40 years. I'd probably ask the question, what returns do you expect over the next 20 or 30 years from both bonds and equities? Because we'll factor that into our recommendation. And a final one that I just don't think is asked as often it should be is, do you expect significant changes during the next 30 years? And the answers to those questions, as we consider them, really leads back to variable products. Now, in terms of the features that are in variable policies today that can reduce risks for consumers, the primary one in most of the policies that we're selling today are guarantees. If the consumer had to ride the roller coaster of equity values being up and down and adjust their premiums based on how equity markets are doing, I can see why they'd be reluctant to buy them. But today's products for death benefit, many of them have significant guarantees. And as you can see from this first example, for the cost of a single premium, male age 65, the best guarantees are actually in variable products today. In this second example that I offer, we have what's the cost for guaranteed premium for 15 years. Now, when we look at term insurance, yeah, the cost is lower, but the coverage is done after 15 years. The other three options that I've put up here are 15 pay policies that guarantee the policy to age 120. Now, we look, whole life is about 40%, 50% more to do that than a variable policy with guarantees. But I also showed a universal life with secondary guarantees slightly less expensive, about 8% less. Now, why? If we just look at that, you'd say, well, if you're looking for the lowest price, it's term insurance, but it's different. But the variable policy is in many ways different than the universal life with secondary guarantees, because at reasonable earning assumptions, the death benefit will double at the client's life expectancy. Also, when we talk about reducing risk for consumers, which features reduce risk? It's also having a separate account that is protected from the insurance company's creditors, or could be rated to use for other products that turned out to be mispriced. And finally, the feature that makes a lot of sense in a volatile market is dollar cost averaging. And when clients pay an annual premium for life insurance, they are dollar cost averaging by paying those premiums each year. And life insurance provides, if it's an annual premium, automatic dollar cost averaging through good markets, through bad markets, and it's continuing to pay premiums in those times when markets are bad that can often make the policy work better. I have here a range of returns for various time horizons. One from 1987 through the present, one from 2000 through the present, one from 2007 through the present, and one from 2009 through the present. This is pretty interesting as we look at it. We show a lump sum invested during any of those periods of time could produce anywhere from 6% through 13.5%. Works better if you buy low and sell high. But our worst return would happen if somebody happened to put all the money in 2000 and got to see the market go down immediately and go down again in 2008 with a slight dip today. Now, when I look at that same time period, and instead of putting all the money in up front at one point in time, if it's put in on a monthly basis, as let's say premiums would be put in, instead of having a 6% return, we have a 9.21% return because units are being purchased when the market is low. So dollar cost averaging really works for the consumer with variable life. So it's a combination of guarantees, safety of separate accounts, and dollar cost averaging that still makes sense for variable products today. So this is one component of what world-class life insurance professionals do in helping their clients determine what type of insurance is best. We've written a book about it called Life Insurance 10X, and it's how we help insurance professionals at Valmark deliver results that are better for their clients. Thanks for listening today, and at Valmark Financial Group, we bring the golden rule to life.